Hello again, and welcome to the second episode of Chapter 2. As you will recall, in Chapter 2, we've talked about how to record transactions using debits and credits. In fact, let me get my picture out of the way here. As you'll recall, we took every column in the accounting equation and we split it into two sides, a debit and a credit side. And then your point of reference is the equal sign in the accounting equation, assets equal liabilities plus owner's equity. Everything to the left of the equal sign, all of your assets increase on the left, the debit side. Everything to the right of the equal sign, liabilities and owner's equity, all of them increase on the right, which is the credit side. And then when we got over here under retained earnings, all of the different pluses and minuses to retained earnings, things like revenues, expenses, and dividends, instead of bunching all of those together in that one account, we broke them out separate into these different temporary accounts. And we represented the temporary nature of these accounts with dotted lines. I call them temporary accounts because we're only going to use them temporarily. We use them to cluster together the revenues and the various types of expenses to make our job of making the income statement a little easier when we get to the end of the period. But after we make the financial statements, then we're through with those temporary accounts, and we want to move all of this information that really represents pluses and minuses to retained earnings. We want to move all that information back up here. Let me give you an illustration of that. So here I have a retained earnings account, and I don't have any of the temporary accounts underneath it. Instead, we had a beginning balance of 40, and then I put revenue straight into that account, and then we had different types of expenses. Over here we had some wages, we had some rent expense, we also had some dividends. And in a real life situation, you would have a lot more different types of expenses. And anyway, all of that information would be jumbled together in that retained earnings account if we're not using temporary accounts. But instead of doing that, what we're going to do is we're going to take all that information and break it up into separate temporary accounts. So for example, that $40,000, that was our beginning balance in retained earnings. I'm going to just kind of color these things to represent what we had over here. The revenues, those three credits for revenue, those we are splitting out into a separate revenue account. And then we had three different debits for wages expense. And so we will put those into a separate wages expense account. We also had one rent expense. See if I can match the colors here. And then we had a dividend account. And let's see, that is right there. Okay, so what I'm doing, instead of having all that information jumbled together in that retained earnings account, we're separating out all of those temporary accounts and clustering the different pieces of information together, and that makes it a lot easier to make the income statement. So at the end of the period, the revenues we can just take to the income statement right here. Wages expense of 33, it's all totaled up, and that goes to the income statement. So does the rent expense, and we calculate our net income. And then that net income comes down here to the statement of retained earnings, of $9,000 is added to the beginning retained earnings, and then the dividends, which is also identified in its own separate account, is subtracted, and that gives us an ending balance of retained earnings of $45,000. So we have all of this information broken out into these various temporary accounts, and that makes the job of preparing the income statement and the statement of retained earnings much easier than if we just had everything clustered together as we did before. However, now that we're through with the period, we're ready to go into the next year. And think about next year. What is the beginning balance of retained earnings in the next year? Well, it should be whatever the ending balance is this year, $45,000. But if you look at the retained earnings account, it still has that old beginning balance. It hasn't been updated yet. So the very last thing to do at the end of the year, after you make your financial statements, is to do what's called the closing entries. The closing entries have a double purpose. We want to set all of these temporary accounts back to zero and get ready to start accumulating information for the next year. And we also want to transfer all this information back up here into retained earnings. And once we do that, the ending balance of retained earnings should match the $45,000 that we calculated. In fact, that's what it would have been had we put all this information up there to begin with. So again, we broke out the temporary accounts simply to make our job easier when we make the financial statements. Now we've done that, and we want to get ready for the next period. We're going to do that with two closing entries. I've got them identified right here. The first closing entry is we're going to close out. I'll just put a color on it so that we can identify it easily. We're going to close out all of the income related accounts and transfer the net income to the retained earnings account. So the revenue account has a $50,000 credit balance. So to set that back to zero, we need to debit that account. That's what we're doing with this first closing entry. We also want to set these different expense accounts back to zero. Now they have debit balances. So if we credit each of them, that would zero those accounts out. So once we do that, that will close the revenues and the expenses. But the difference between those two, remember our journal entry has to balance, the difference between those two will be the net income, and we want that net income to be transferred up here to the retained earnings account. And it'll be a plus because net income increases retained earnings, so that'll be a credit. So notice what happens when I post this entry. The $50,000 debit goes to revenues, and so that closes that out. And then the wages expense is credited for $33,000. That goes back to zero. The rent expense is credited for $8,000. That goes back to zero. And then the $9,000 plug, which is the difference between the two, is going to be credited to retained earnings. And remember, that's our net income. So what we've done here is we have added the $9,000 of net income to the beginning balance of retained earnings, which is what we had, that was the first step on the statement of retained earnings. So the closing entries are accomplishing what we calculated on the statement of retained earnings. The second closing entry takes care of the last remaining temporary account, Dividends, it has a $4,000 debit balance. We want to credit that account to get rid of it. And so we credit dividends. We're going to debit retained earnings because essentially what we're doing is moving that $4,000 up here where it would have gone to begin with if we weren't using the temporary accounts. So here's the entry. I'll go ahead and put a nice little color to it so we can see it easier. And so the dividend account gets a credit, 4,000. That goes back to zero. The retained earnings gets a debit of 4,000. Again, that was the dividends. And now the ending balance of retained earnings is the 40,000, the beginning balance, plus the 9,000 net income, minus the 4,000 dividends. And that gives us an ending balance of 45,000, which is what we calculated it should be. So now as we go into the next period, the beginning balance in the next period of retained earnings is 45,000. Let me show you a more involved example. Here's the journal and here's the ledger for problem 25A that you may have worked when you were doing your homework earlier. So, the journal entries, we recorded all the transactions, we posted to the ledger, we totaled up all of the account balances, and let's focus on this information here in the retained earnings column. I'm going to put a different color to that so we can see it. So let's focus on what's happening under retained earnings. We had a beginning balance of 21.5, and then we had all these different pluses and minuses that were revenues and expenses and some dividends too. The information on the temporary accounts went to the financial statements. Here's the income statement. Here's the statement of retained earnings. Again, notice that the retained earnings had a beginning balance of 21.5, and that's what we had in the retained earnings account. And now we want, after we make the financial statements, we made the income statement, we made the statement of retained earnings, here's the balance sheet down here. And when we're through with all that, we want to do the closing entries, close out all of the temporary accounts, and move that information up into retained earnings. And when we're through, the ending balance of retained earnings should be 55,200. So here's how that works. See if I can get over there. So our closing entry, this is just, I'm just kind of moving theoretically, this is the bottom of the journal. After our transactions, we're just skipping a few lines down and we're going to make closing entries. The first closing entry is to take care of all of these income accounts, all of these accounts, revenues and expenses. So we're debiting revenues for 73.6. That's when we debit the revenue account for 73.600, it goes back to zero. All of these different expenses are going to be credited to set them back to zero. Credit wages expense for 14,000. Credit utility expense for 6,300. Credit rent expense for 4,600. And then credit depreciation expense for 7,000. So that sets all of these income accounts back to zero. But the journal entry still doesn't balance until we put the difference between the two, which is our net income, and we're going to credit retained earnings for $41,700. So when I credit that $41,700, that's closing entry number one. And what we've done is we've added the net income to the beginning balance of retained earnings. We still have one more temporary account to close. That's the dividends. So I'll do that here. And so, again, that's to take care of this account. So we're going to credit the dividends for $8,000. When we do that, it goes back to zero. And we are basically moving that $8,000 up here, that debit, to retained earnings. That's closing entry number 2. And that reduces the retained earnings by the dividend amount. And now the ending balance of retained earnings is equal to that $21,500 beginning balance plus the net income minus those dividends. $55,200, and that is exactly what we had calculated it to be on the statement of retained earnings. So again, the closing entries, it's not super complicated, but it is super important. What we're doing is we are taking all of that information that was on the income statement and the statement of retained earnings and wrapping it all up together to get that ending balance of retained earnings, and that is the balance that's going to be reported on the balance sheet. That's the number that brings the balance sheet into balance, that ending balance of retained earnings. So one other final comment about that, I just like to represent it this way. The temporary accounts are kind of like a stopwatch. These accounts that I draw with a dotted line, those are temporary in nature. We create them to collect the revenues and expenses and dividends that happen during the period. The reason we do it is it makes it easier to make the income statement and the statement of retained earnings. But after we've done that, when we get to the end of the period, we want, it's kind of like a stopwatch. You always have to set the stopwatch back to zero before you start the next race. And that's what we want to do with these temporary accounts. Set them back to zero and we're ready for the next year. Balance sheet accounts are not like that. Balance sheet accounts are more like a dipstick, the way you check your oil. And so like assets, you've got a cash account. The balance in the cash account tells you how much you have right now. The balance in your liability account tells you how much you owe right now, today. But these temporary accounts, they tell you this is what's happened throughout the year. They're accumulating information for the year, set them back to zero, and they start over again. So anyway, that's the difference between balance sheet accounts and income statement accounts. Income, all of these dotted line accounts, income accounts and dividends, we call those temporary accounts. Balance sheet accounts, we call those real accounts. They are real. They stay there from one period to the next. Whatever you have at the end of one period, that's the beginning balance for the next period. Okay, so that's closing entries, and work with that, do some homework. Extremely important to understand how that works. See you next time.